Welcome to ETM Analytics and Treasury One's weekly market review. This week, I'm joined by Vichard Cilliers, Treasury One's head of market risk. Thank you very much for joining me. And all the focus ended up on Friday with the US non-farm payrolls. The data, of course, came in soft. It's still not a train smash. It came in at 175k jobs added, but it was compared to the 240 that was expected. That's 240,000 expected. But like I said, softer, yes, but not a train smash. It's really just the tighter monetary policy environment that we're seeing that is really asserting itself on the labor market. And we've been tracking this type of data for a very long time to see when it will finally start showing up, and it seems like it has. And of course, this obviously mixed everything up again.
Yeah, it's a good afternoon to everybody. Yeah, it was an interesting figure that came out. Market was very bullish still. This is the lowest number of jobs that's been added in the past 6 months, and also it created an unexpected rise in unemployment. Unemployment rose from 3.7 to 3.9%, still below the 4% threshold that they want for full employment, but it's on the rise. It prompted people to look at the economy a little bit differently now, on this form for payroll numbers. And the cracks that we spoke about previously in the past 2-3 months is definitely starting to show up now with this non-farm payroll number. That US exceptionalism that everybody's been owning is probably starting to wane. And the data going forward will be very interesting to see how that will impact how the US economy is going forward. Like I said, still not a train smash. It's still not negative. Still not declining in jobs. Wage growth was flat. Unemployment, like I said, was up again. But yeah, so it's interesting to see that how it will continue from here.
Yeah, like I said, it's really just the beginning of the cracks that we have waiting now for I think for more than a year now to start seeing popping up. Then we would jump to the City Economic Surprise Index, which for the first time since beginning 2003 has moved into negative territory.
Yeah, so this is a little index that Citibank puts together sort of on a daily basis just to see how the US economy is shaping up. And like we just said, it's now turned negative after the US non-farm payroll numbers, the first time since January 2023. And everybody's been talking about cracks in the US economy starting to show up, and the economy needs to start negative, but it hasn't happened. Now, for the first time, this index that Citi puts together is sort of saying, hey, there's problems on the rise. All is not well. Even we've spoken about the 2-year and the 10-year yield curve that's inverted. That shows there must be a crack. Other thing that's also interesting is Berkshire Hathaway is sitting on the biggest pile of cash that's sitting in the history. And Warren Buffett said out, in current economic conditions, why not sit on cash and just earn the yield? So there's a lot of indicators now, and we've been advocating it for a while. I think we've been wrong for a while, but it's and I say even a broken clock can be right twice. But definitely this cracks that we've spoken about previously is definitely starting to show, and it will put pressure on the US economy going forward and the rest of the world.
I don't think we were wrong in calling it. I think our timing was we didn't expect it to take so long to start showing up. I think we were all kind of calling it.
It's all about the timing, but like I said, it's been inevitable. It's just the rest of the world just can't be under pressure, and the US just continues one direction. It's sort of that crocodile's teeth that opens up. The discrepancy and the widening is just too big. So somewhere something in the US also needs to give.
And obviously the softer data out of the jobs market, and you take something like the surprise index, and we see the pressure piling on the Fed to start turning more dovish in their stance. Feels like I'll put it this way: another week, another rate cut expectation shakeup, because that's how it feels to me right now. It feels like we're changing this. The Fed Fund futures changing every week, where we have our first rate cut now priced in for September, but the December rate cut expectations upped a lot on the back of the US jobs data from Friday.
Yeah, that stems after the Federal Reserve announced an interest rate cut on Wednesday as well, keeping their stance, and then Jerome Powell came out and said, we're going to be higher for longer. We're not expecting our next move to be a hike, but we're not expecting to cut anytime soon. So then the market sort of priced, we're not going to have cuts in 2024. Although beforehand they priced November cut, after Wednesday no cut for the year. Then all of a sudden the non-farm payrolls prints a little bit worse, and all of a sudden September is now back on the cards, and even September and November, 2 cuts for the year is also on the cards. So it's just 7 cuts in the beginning of the year to no cuts, back to 2 cuts. It's a roller coaster. It's like the interest rate plays is like the emerging market currencies at the moment. It's a roller coaster. The one day it's up, the one day it's down. So it will still, again, it will be all data dependent. We've got 8 Fed speakers this week speaking about having speeches about what's going to happen in the US economy. So it'll be interesting to hear what they say about as well. Bostic, it's always been a hawk. He's speaking this week, so we'll see if he dials back on just keeping higher for longer, or he prices in a cut this year. But yeah, for now, it's all. We'll need to see when they eventually push the button to see to be right if the cut's going to be September or is it going to be November. But again, data is critical at the moment for the US.
Yeah, it feels like markets are kind of on tenterhooks, and we get almost a disproportionate reaction to the slightest move, or slightly softer data has this massive impact at the moment, and just shows you how on a knife's edge I think markets really are on the situation and inflation and the possible rate cuts. So I don't know how long the tension is still going to last, but it might still be with us for a while.
No, definitely, like you said, it's all of a sudden next week we get inflation data again. It prints higher again. Everybody says no, higher for longer, and they price out the September rate cut again, and then be back to 1 cut in November. So geopolitical risk is we haven't spoken about it in the last 2 weeks because there hasn't been much on the geopolitical fronts being quiet, but that just needs to flare up again, and then it's a different scenario. So it's also headline driven at the moment. It's so difficult to see where it's going to go. It's until we see some certainty in the actions that's going to happen, then we'll know where the market really wants to go.
But for now, markets expect the Fed to turn softer, at least sooner than we expected last week. So the emerging market currencies are all smiling. The rand, it definitely gained some momentum on the back of that last week.
Yeah, no, definitely. So we saw the rand this morning trading at below 1850 again, 1847. We went all the way back from 1920 to 1850 in a couple of days, 3 or 4 days. Big move again. Rand was the leading emerging market, and that's just a factor from the dollar is on the back foot a little bit. The euro jumped, the pound jumped. The yen came all the way back from 160 to 154. So a little bit of dollar weakness, and the rest of the market rallies. And again, it's just as soon as the Fed pivots, the dollar will come under pressure. So we still 1820, 1920 in the short term until anything gives. Obviously, there will be a lot of interest in the rand in the next 3 or so weeks in the run up to the election and what's going to happen there. I see this morning there was an Ipsos poll that came out, and it all depends on what the voter turnout is going to be. They say low voter turnout, the ANC is going to perform well. Higher voter turnout, the ANC is going to perform poorly. So we'll need to see it. We definitely expect the volatility in the currency in the lead up to elections and the results afterwards, and to see who the ANC is going to form a coalition with. So for now, importers must definitely look to cover themselves in the short term at these kind of levels. Will be our.
It is just to add on, because there is obviously uncertainty leading up to the elections on the 29th of May. And I've said this previously, but just to highlight again that uncertainty might last well into a week and a half, maybe even 2 weeks after the 29th of May, depending on when the first sitting is called, when the new MPs are sworn in. And as soon as they're sworn in, they get to vote for a new president. And then we will see a definitive coalition line emerging. And that can happen, like I said, 2 weeks after the post-election. So there's still some big room for a lot of uncertainty to play out over the next month and a half even, if anything happens. But Vichard, I think we will catch up again on Monday. Not very big data movers this week. They could see another rate cut shake up, but who knows?
No, like I said, the only big things this week that really needs to worry us is initial jobless claims out of the US on Thursday, and then that Fed speakers. That's the main culprits this week. It can be move the market. So for now, it will be all driven by what happens in the dollar. But yeah, we'll chat
Great.
next week again. Thanks, Marie.
Thanks, Vichard.
Cheers.